Hello. Yeah. No, we are not waiting for anyone else to attend. It's just that I'm just going to start off. Wait a bit. Testing 1, 2, 3. Okay, just give me a minute more, please. And I'm going to testing 1, 2, 3. Testing 1, 2, 3. Okay, I'm hoping that I'm audible to everyone. Okay, good enough. Thank you very much, all of you. Thank you for your patience. Thank you for your time. Thank you for attending the session. We are going to start off with the AAA class today. And the agenda of today's session is that we will be going through the exam practice questions. I repeat, we'll be going through the exam practice question on an area which is a very important area for the AAA paper, which is the business risk and the audit risk. I am actually going to share an exam question with you people in the WhatsApp group. So just in case, I'm just going to share it. Just give me a minute. I'm going to share it. Okay, just in case if anyone does not receive this handout, you can actually WhatsApp me and I'll just make sure that I reshare it. But just in case if you don't receive this handout, let me know. I'm sharing my number so that you could actually share it, which is basically okay. I've shared this handout, plus I've also shared my WhatsApp number. So just in case if any one of you have not received the handout yet, just let me know and I will actually share this handout with you people. Okay, so let's just start off. Let's just start discussing about this question which is in front of you. I hope everyone has got it right. Everyone has got it? Okay, so now let's just start discussing. Okay, Ram, if you haven't received it, I have shared my WhatsApp number. You can WhatsApp me and I'll be able to share it with you people in case if you haven't received it in the relevant WhatsApp group. Okay, so let's just start off. Let's just start discussing about this specific area. So this is a question in front of you, which is actually a question number 1 of a typical AAA examination. So what I will do is I will go through this exam question. I will tell you the technique to deal the exam question and how exactly do you need to write down the answer to the exam question. So we are going to discuss this whole approach. The first thing is, this is a 50-mark question. So that means if we think from the perspective of the exam, so we have got our paper which is of 3 hour and 15 minute. So if it's a 3 hour 15-minute paper, which actually means 195 minutes of the paper, of which you would expect to allocate approximately 98 minutes to this specific question. Now see, so how exactly are we going to handle such type of question in the examination? We are going to discuss that technique also. This is a typical question number 1. And if you look at the typical examination structure, you would see that there is a small brief overview about the company. And after this brief overview, they require you to respond to the instructions in the email from the audit engagement partner. And then there is always an exhibit which gives you the email which you have received requiring, mentioning all of the requirements that you have. And then what happens is that then the actual question starts off, which is about the various exhibits which are part and parcel of the questions. So exhibit 2, exhibit 3, exhibit number 4, exhibit number 5, and so on and so forth. Now let's start discussing about this question. And the important thing is that whenever you are dealing such a big scenario, it's always important that you take down the notes as soon as you progress through the scenario. It's important that you take down the notes as soon as you progress through the scenario. So let's just start discussing about it. It says you are the manager in the audit department of Huntsman and Co., a firm of chartered certified accountants responsible for the audit of several companies and for evaluating the acceptance decision in respect of potential new audit clients. Now see, and evaluating the acceptance decision in respect of potential new audit clients. Always remember one thing, which is basically that whenever you are being offered an opportunity to accept a new client, I repeat, whenever you are being offered an opportunity to accept a new client, don't just accept the client because you are being offered the client. No, you have to make sure that you look for the multiple aspect, which is the legal, the various ethical, the commercial, and the professional aspects that you have to look after whenever you have to go for accepting a client. Now, what exactly are those legal, ethical, commercial, professional aspects? We are going to discuss them later on. Don't worry about it. But I'm just telling you, in case if you are ever just being offered, in case if you are ever just being offered this specific thing, that you're being offered the scenario where you are being offered a client, don't just accept it. You have to make sure, you got to make sure that you look after the legal, ethical, commercial, professional, all of these aspects. Then you go about with the acceptance of the client. Now let's move a bit forward and discuss further. The next aspect is basically it says one of your audit clients is Redback Sports Company. So what is the company's name? The name of this company is Redback Sports Company. What is the company name? The name of the company is Redback Sports Company. Now, it says which operates a chain of sport and leisure centers across the country. So what is this Redback Sports Company operating? They're operating the chain of sports and leisure centers across the country. The company has a financial year end of 28th Feb 2009. So one of the important information is 28th Feb 2000X9 is the year end for which we are working. And you're about to start planning the audit. Stella Cross, the audit engagement partner, met with the company's finance director last week to discuss business developments in the year and the recent financial performance. Now, what is happening is that your audit manager or the audit engagement partner, she has actually met the finance director to discuss about the changes. In addition, Stella has been approached by Mick Emu, the managing director of EMU Gyms company. Mick has inquired regarding whether Huntsman and Co can provide the company with the audit or limited assurance review. And Stella would like you to evaluate this request. So basically in this scenario, there are two types of the situation. One of them is about the Redback sports company, and one of them is about a new client, the name of which is EMU Gyms. So what do you need to do? You need to cover up these two situations in the scenario. And what are these two situations in the scenario that you have to cover up? One of them is you have to make sure that you cover up what? You cover up this Redback sports company, and the other one of them is you cover up this EMU Gyms. Now what next is there? The next situation is it says Huntsman already provides a payroll service to EMU Gyms company. So what you are already doing is that you are already providing the payroll services to EMU Gyms and has assisted Mick with his personal tax planning in the past. Okay. So what is actually happening is that with respect to EMU Gyms, you have already been providing them with the payroll services and you have assisted their CEO with their tax planning, the personal tax planning. That is what has happened with you. Now, what next is there? The next situation that we need to understand is that it says Mick also has a suspicion that several employees are carrying out fraud at the company. Okay. So there is also a hint of fraud. And he has asked whether an audit or limited assurance review would have alerted him earlier to the situation. Okay. So he wants to know that whether it's the audit or it's a review which actually helps you detect fraud. What is it that actually helps you detect fraud? Is it an audit? Is it a review? What is it that actually helps you detect fraud? You are provided with the following exhibits. So what are the various exhibits that we are being provided with? So the various exhibits that you are being provided with include what? Number one of them is it include email you have received from Stella Cross in respect of both Redback Sports and EMU Gyms. Notes of meeting which Stella had recently with finance director of Redback. Extract from latest management accounts of Redback. Notes of a telephone conversation which Stella had with Mick EMU, managing director of EMU Gyms. Now, requirement is respond to the instructions in the email from the audit engagement partner, and there is another requirement which is of 4 marks, and that is the professional marks. That is what we call them, the professional marks, which are going to be of 4 marks. Now, what next is there? It says exhibit number 1. What does it say? It says exhibit number 1, which is the email from the audit engagement partner. It says to audit manager. What is it? To audit manager from Stella Cross, so and so, so and so. I provided you with some information in the form of number of exhibits, which you would use to help you with the planning the audit of Redback Sports for financial year so and so. Using information in exhibit 2 and 3, I require you to prepare briefing notes for my use in which you evaluate the business risk to be considered in planning the company's audit. Evaluate the risk of material misstatement to be considered in developing the audit strategy and the audit plan. The third one of them is design principal audit procedures to be used in the audit of grant received from the government in September 2008. Now you see, when you come across such a huge scenario, it's always good that you adopt a work breakdown structure. What is this work breakdown structure? The exhibit 2 and exhibit 3 are going to help us answer requirement A, B, and C. The exhibits A, exhibit 2, exhibit 3 are going to help us answer the requirement 2 and requirement A, B, and C. So we are not going to waste our time going through the relevant remaining part of the question right now, but we would rather cover up only single part right now, and then we would read through the exhibit number 4, and while reading through the exhibit number 4, we'll talk about the part D and the part E, which is 8 and the 6 mark. So it's actually going to be like this, that we would first initially attempt part A, B, C, then we would attempt part D and part E. So let's talk about the first part of the question. Okay. The requirement is evaluate the business risk to be considered in planning the company's audit. It's an 8-mark requirement. Now, always remember, whenever the scenario comes to you, which is the examiner says evaluate. What does it say? Evaluate the business risk. Evaluate the business risk. So the word evaluate would actually mean what? The word evaluate would actually mean that you have to identify and you would have to explain what are the risks. You would have to identify and you would have to explain the risk. You just don't have to identify. You have to identify plus you have to explain that why is it a risk. The second thing is that when we talk about the concept of business risk, so let's try to have an understanding of this, that what exactly do you mean by business risk. So when we talk about the concept of business risk is a risk that the entity will not be able to achieve its objective. So I repeat, when we talk about the concept of the business risk, what exactly do you mean by the business risk? Business risk is a risk that the entity will not be able to achieve its objective. Now let's talk and let's discuss about it. Basically, what do you mean by the risk that the entity will not be able to achieve its objectives? So let's try to have an understanding. Basically, there could be the multiple objectives of the organization, but the broader objective that we have with respect to any organization, I repeat, the broader objective that we have with respect to any organization is the shareholder wealth maximization. I repeat, the broader objective that we have with respect to any organization is the shareholder wealth maximization, that we wish to maximize the shareholders' wealth. Now, if we wish to maximize the shareholder wealth to anything that would have an adverse impact on the entity, I repeat, anything that would have an adverse impact on the entity would actually prevent you from achieving your business's objectives. Now, what exactly do you mean by this? Try to understand. Basically, what happens is that assume that, for example, if there is an economic recession, the overall sales of the business are going to go down. For example, if there is a raw material availability which is in shortage, so ultimately the cost of goods sold would going to go up. For example, you have got labor issues, that the labor is not available, again the cost of goods sold would go up. For example, you have got a high fixed cost. The high fixed cost would ultimately means that in times of poor times, ultimately what happens is the business would run into losses. For example, there may also be the case where we would say that we have got the foreign exchange transactions. So when you have got the foreign exchange transaction, there is actually a risk of the adverse movement in the cash flows. There's a risk of adverse movement in the cash flows that we come across. So I repeat, what do you need to do? You need to keep this thing in mind, that anything which could have an adverse impact on the entity, which could prevent the entity from achieving its objective, that is going to be considered as a business risk. Now, if I move a bit forward and discuss further, so you need to understand this thing, that what you could do is that in simple terms, you could apply the pestle model. And this pestle model is going to help you identify the business risk. What is this pestle model? Which is that you apply, you look at the political aspects of the organization, that the country, the government, etc., in which we are operating, the economic environment, that how exactly is the economy operating, the social environment, that what are the social preferences, the technological environment, what are the technological developments, what are the technological advances, that is something that is going to have an adverse impact on the entity. Then there is going to be something which is the ecological, the overall change, and the legislative aspect. So you need to consider all of them. So one of the ways of thinking about the business risk is that you look at the pestle model. I repeat, one of the ways of looking at the business risk is that you look at the pestle approach. That when you have got the pestle model, so the pestle actually tells you what? The pestle actually tells you that how the political factors could have an adverse impact on the entity. The pestle tells you that how the economic factors could have an adverse impact on the entity. It tells you how the social factors, how the technological, how the ecological, etc., etc., how could these factors have an adverse impact on the entity. That is what the pestle tells you. So I repeat, that is what the pestle tells you. So whenever we talk about the concept of pestle, always remember this thing, that the pestle would actually be telling you the business risks that are being faced by the entity. Another approach of identifying the business risk is that what you could do is you could have, I repeat, another way of identifying the business risk is that what you could do is that you could apply the Porter 5 forces model. I repeat, what you could do is that you could apply the Porter 5 forces model. What are these Porter 5 forces model? If you could just have a quick recall of these Porter 5 forces model, so you would realize this thing, that the Porter 5 forces actually are what? The bargaining power of the suppliers, the bargaining power of the customers, the threats of new entrants, the competition, and lastly, the alternate products. So all of these things, I repeat, all of these things could have an impact on how the entity operates. Okay, so that is also one of the approach of identifying the business risk. That is that ultimately the organization won't be able to achieve its objective. So this is something that you could do. Now, so one of the requirement to the question is you need to evaluate the business risk to be considered in planning the company's audit. So we would talk about the different business risks that are being faced by this entity. Another requirement to this question is evaluate the risk of material misstatement to be considered in planning the audit strategy and audit plan. If I talk about the concept of the risk of material misstatement, so you do have an idea. I repeat, when I talk about the concept of the risk of material misstatement, so you do have an idea that whenever we talk about the concept of materiality, what is materiality? An item could be material. I mean, the materiality could be judged on the basis of quantitative aspects, and the materiality could be judged on the basis of qualitative aspects. What exactly do you mean by the quantitative aspects? So generally there are these thresholds that if an item is more than 5% of the profit before tax, that's going to be considered as material. If an item is more than 2% of the total assets, that is going to be considered as material. If an item is going to be more than 1% of the sales, so that is going to be considered as material. Generally speaking, this is what the materiality is. This is generally how we establish the materiality. Now, the second aspect of this is that there are these qualitative aspects of materiality also. What are these qualitative aspects of materiality? So when we talk about the qualitative aspects of materiality, that means few of the transactions become material because of the nature. Like every related party transaction, irrespective of the amount involved, is going to be considered as a material transaction. Every related party transaction, irrespective of the material involved, irrespective of the amount involved, is going to be considered as a material transaction. So I repeat, when we talk about the concept of risk of material misstatement, there are two important aspects to it. One of them is what is materiality. So we have discussed what materiality is. Now, even if we talk about this quantitative and qualitative aspect, always remember that with respect to the materiality, it's always going to be the judgmental thing. The materiality is always going to be judgmental. You can't say that this is material or this is immaterial. It's always going to be something which is judgmental. I repeat, it's always going to be something which is judgmental, which is dependent upon the auditor's understanding, which is dependent upon the auditor's interpretation. That is what the materiality is going to be. Now, when we talk about the concept of misstatement, the misstatement could actually be two things. The misstatement could be two things, which is there are few things which could be overstated. There are few things which could be understated. There are few things which could be overstated. There are few things which could be understated. So being an entity, you would always want, I repeat, being an entity, you would always want what? You would always want your assets. You would always want your sales to be overstated. Because generally speaking, an entity whose assets, whose sales are overstated is considered to be a good entity. Similarly, when we talk about the concept app, when we talk about the concept of understatement, generally speaking, it's the liabilities that every entity usually tries to. I am repeating usually. I'm not saying always. There could be the opposite case also, but it's usually the case you try to understate the liability, and it's usually the case that you try to understate the liabilities and the expenses. So generally speaking, we try to understate the liability, we try to understate the expenses. Now, let's move a bit forward and discuss further. The next aspect is that if you wish to understand the concept of misstatement, there are two ways of understanding the concept of misstatement. And what are two ways of understanding the concept of misstatement? The two ways of understanding the concept of misstatement is that one of them is you could see that the misstatement is the non-compliance. The misstatement is the non-compliance of the applicable financial reporting, framework. So when we talk about the misstatement, what exactly do you mean by misstatement? The misstatement is, one of them is non-compliance of the applicable financial reporting framework, or the misstatement could be considered as the non-validity of the assertion. The non-validity of the assertions. So if I talk about the misstatement from the perspective of the entity, I would tell you people that the non-compliance of applicable financial reporting framework would mean what? If I talk about any of the IFRS, generally speaking, there are multiple things in any IFRS, which is that number one point is that there is always a scope paragraph. The scope paragraph actually tells you the applicability of that IFRS. So like, for example, if we have got IS 41, which is applicable on living animals and living plants. But there is an exception, which is that there's something which is called bearer plant, and the bearer plants are covered under IS 16 property plant equipment. So just in case, if it happens like this, that if you account for bearer plants under IS 41, so that is actually going to be misstatement. Why? Because that's a wrong financial reporting treatment that you have applied. So when we talk about the concept of the financial reporting framework, non-compliance of applicable financial reporting framework, the non-compliance could be with respect to a lot of things. And amongst those lot of things, one of them is going to be the scope paragraph. I repeat, amongst those things, one of them is going to be the scope paragraph. What is that scope paragraph going to be? The applicability of the IFRS. If the IFRS is applicable on a transaction and you apply it, that is okay. But if the IFRS is not applicable on a transaction and if you apply it, that is not going to be considered as an okay thing. Now, similarly, if I could give you more examples, so there are multiple examples of the IFRS. One of them could be that maybe possible the measurement criteria. The accounting standard says that you have to measure it, you have to measure an asset initially at cost, and if you measure at fair value, this is again going to be misstatement. So basically what happens is every single thing of the accounting standard, whether that is the scope, whether that is the measurement requirement, which is the recognition requirement, derecognition requirement, or the disclosure requirement, if there is any specific requirement of the accounting standard that is not being followed, this is ultimately going to be considered as your misstatement. I repeat, this is ultimately going to be considered as misstatement. So when we talk about the concept of misstatement, so one of the aspect of the misstatement is non-compliance of, I repeat, misstatement is non-compliance of applicable financial reporting framework. And I gave you examples that what could be the non-compliance of applicable financial reporting framework. The non-compliance of applicable financial reporting framework could be anything. Could be like you are non-complying with the scope, you are not complying with the measurement requirement, you are not complying with the recognition or the derecognition criteria, or you're not complying with the disclosure requirement. All of them is going to be considered as what? All of them is going to be considered as your aspects. If any of these aspects are not being properly followed, that is going to be considered as a misstatement. Now, let's move a bit forward and discuss further. The next aspect of this is that the misstatement could also be the non-validity of the assertions. Now, what exactly are the assertions? I always tell my student that you could remember the assertions using this mnemonic, which is C square compare. Now, what exactly do you mean by this mnemonic of C square compare? Let's have a discussion of that. First of all, when we talk about the concept of assertions, so assertions are basically the deemed declarations from the management, that they have complied with these aspects while preparing financial statement. So when we talk about the concept of assertions, what exactly do you mean by assertions? Assertions are what? Assertions are the deemed declarations from the management that they have complied with these aspects while preparing the financial statement. Now, what exactly do you mean by this? So let's try to have an understanding of this. Basically, what happens is that what are these aspects? So let's understand. I said C square compare. What did I say? I said C square compare, where C is going to be your cutoff, where 1C is going to be cut off. That is, the transactions have been recorded in the correct period. So that's one thing, that the transactions have been recorded in the correct period. Now, what next is there? The next situation is that what next is there? The next situation is that there is this completeness. There's this completeness. Completeness is that 100% of assets, liability, income, and expenses are recorded. So this is actually going to be considered as completeness. So when we talk about the concept of completeness, so what exactly do you mean by the completeness? The completeness is when we say that the 100% of, I repeat, the 100% of all assets, all income, all expenses, all liability have been recorded. That is going to be considered as completeness. Then there is going to be the classification, which is that the items are correctly classified in the financial statement. What exactly do you mean by this? This actually means that if there is something which is an asset, we have classified it as an asset. If there's something which is a liability, we have classified it to be a liability. If there is something which is an income, so we have classified it as income. So what is it going to be considered as? What is it going to be considered as classification? The classification is that when we say that we have appropriately classified each and every item under the proper head, that is going to be considered as classification. Now what next is there? So you've got cutoff, you've got completeness, you've got classification. Then there is this occurrence, where the management claims that the transactions recognized in financial statements have actually taken place. The transactions recognized in financial statements have actually taken place. What is it going to be considered as? It's actually going to be considered as occurrence. So I repeat, what is going to be considered as occurrence? The occurrence is that the management says that the transactions have actually taken place. The transactions have actually taken place. The measurement is that the measurement requirements under relevant Ifrs are being followed. So whatever the measurement requirements are, those measurement requirements are being followed. So what is it going to be considered as? It's considered to be an assertion of measurement, that we are measuring the all of these things, the assets, liability, income, expenses, using the relevant criteria. Okay, the next one of them is presentation and disclosure, which is that the items have been properly presented in financial statement and appropriate disclosures have been provided. And the appropriate disclosures have been provided. So what is it going to be considered as? It's another assertion. Is that okay? Yeah, is everyone okay with this? Now, so here you've got what? C square compare. C square compare is what? Cutoff, completeness, classification. What have we done up till now? Cutoff. We have discussed completeness. We have discussed the classification. We have discussed occurrence. We have discussed measurement. We have discussed the presentation and the disclosure. And what happens is that there's this accuracy, which is actually that the transactions have been accurately recorded. Then what next is there? Rights and obligations. What exactly do you mean by the rights and obligation? The rights and obligation would mean that entity has rights to the assets that it has recognized and is obliged to settle obligations recognized in financial statement. So when we talk about the rights and obligation, this is exactly what we mean with respect to the rights and obligation, that the entity has got the rights to the assets that it has recognized and is obliged to settle the obligations recognized in financials. The next aspect of is this, the next aspect is that there is this existence, which is that assets do exist. The assets do exist. So whatever assets that we have recorded, they do exist. So when we talk about the concept of risk of material misstatement, we are actually saying that the misstatement could be, I repeat, the misstatement could be that either you have not complied with the requirements of the Ifrs, or any of the assertions which are there in your financial statement is not appropriate. That is going to be considered as what? That is going to be considered as misstatement. And in case if that misstatement is of material nature, then the auditor has to be aware, then the auditor has to be alert. So this is what the auditor had to say. Okay, we've got few students, Michael Akoto and James Mokyo. Which specific handout are you talking about? Are you talking about these notes that I'm making, or are you talking about the question handout? Okay, yes. After the class, I'll share this handout in the group. Don't worry. Okay, let's move a bit forward and let's discuss further. The next aspect is, okay, if anyone wishes to get the link to the question or handout or anything, I'm again sharing my WhatsApp number. You can message me now. So what have we done? Thank you, Michael Akoto. Thank you for this. Now, so what have we done? We have discussed about the concept of this risk of material misstatement. The third aspect is that we have to design the principal audit procedures, which I'm going to discuss a bit later. So right now, what I'm doing is I'm giving you people some time, which is I'm giving you some 5 to 10 minutes time. In fact, 5 minutes is going to be sufficient enough. What I want you people to do is that read through this second exhibit, read through this exhibit number 2, and try to see if you are able to identify any of the business risk, or if you are able to identify any of the risk of material misstatement. I am giving you 5 minutes, so you have got time till 12 a.m. that you have to read through this exhibit number 2, and then we are going to start discussing. Okay, so let's just start discussing together. Stella Cross, the audit engagement partner, Huntsman and Co. And then it says Anita Bay, the finance director, Redback Sports Company. It says Redback operates 20 sport and leisure centers around the country. So what does it do? It operates 20 sport and leisure centers around the country. Each center has a large gym and a swimming pool. So what are the facilities at each center? There is a large gym and there is actually a swimming pool. And many also have the tennis and badminton courts. So there are these tennis, there are these badminton courts also. Given the nature of the company's operations, it has to comply with the health and safety regulations set by the national regulatory body, and its facilities are inspected regularly to ensure that all regulations are being followed and for the company to retain its operating license. Now see, what happens is that I told you people that if you have to identify the concept of the business risk is the risk that the entity will not be able to achieve its objectives. So right now, my focus is going to be, I'll be talking about the business risk in general. I'll not be talking about the risk of material misstatement right now. So every single thing that we are going to read, we are going to say, Zulfikar Ali, thank you very much. Thank you for this feedback. Okay, there is a request to all of you that please, when you are writing down answers, so mark your chat to be all panelists and attendees. This is going to help everyone see what you are saying, right? Thank you, Zulfikar. Thank you, Huda, for this. Now see, let's start discussing about this Redback Sports Company. I'm giving you a hint of how the business risk is drafted. So amongst the different business risks, one of them is basically the health and safety regulations. See, when you write down this only, that means you have only identified the risk. When you write down this, that means you have only identified the risk. And considering that this question is only worth 8 marks, my assumption is that there are not many marks. There are not many marks for identification because there are many business risks existing in this scenario. So you can't write the answer like this. You have to explain it. I repeat, what do you need to do? You need to explain it. So what are we going to say? We're going to say, we're going to say that this Redback Sports Company is operating under strict regulatory requirements where there are frequent inspections to ensure that the entity is complying with the health and safety regulations. Any non-compliance could lead to cancellation of operating license and hence will have a direct impact on the going concern status of the entity. So you see, if you wish to evaluate the business risk, what do you need to do? You need to identify the risk and you need to explain it that why is it a risk. And the way you have to do it is, this is the approach. The way you have to do it is that this is the approach that there are people, thank you Huda, thank you Anania, thank you Zulfikar for identifying these things, that you've identified that there is there's a risk of non-compliance with health and safety regulations. So how exactly are you going to mention this in the examination? This is the way of mentioning it. You would say, you would give a brief background that the entity has to comply with the health and safety regulations. And then you would say that in case if the entity does not comply with these health and safety regulations, so ultimately it would not be able to retain its license, and hence its going concern is going to be compromised. Now, let's move a bit forward. The next part of them is that the company is not listed and therefore does not need to comply with local corporate governance regulations. Okay, so you are not listed. The COCG is not applicable on you. However, the company's chief operating officer and the chairman consider it good practice to have independent input to the board. Okay, so they have got a good practice to have independent input to the board. And there are two non-executive directors. One of the NED is a leisure industry expert who has a chairman, who was a chairman of rival company, Lyre Leisure, for 10 years. The second non-executive director is an academic who specializes in organizational behavior and who has written several books on performance management in the sport and leisure industry. Now, this is something which is good. Although the requirements of the code of corporate governance are not applicable on you, but you will still try to follow the requirements of the code of corporate governance as a good practice to ensure that the organization operates under a good governance. Now see, the board has approved a plan to expand through acquiring other leisure and sports facility providers. That strategy is not likely to be implemented for another 2 years, when the board would like the first acquisition to take place. However, the potential target companies will be identified in the next 12 to 18 months. Ultimately, the board would likely like to seek a flotation of the company within the 5 years. And they consider that expanding the company would improve profits and make a stock listing more feasible. Now, see, what happens is that there is only one single business risk that I can identify here, which is that the expansion plans of the entity. The entity plans to expand by acquiring other competitors. These expansion plans could divert the management's focus and attention from the existing business, and their time would be spent in integrating the operations of the acquired businesses, resulting in likely deterioration of controls / quality at the existing business. Always remember, whenever you try to expand, I repeat, whenever you try to expand, you ultimately lose focus from the existing business. Why? Because your focus gets shifted to the new business, to settle the new business, to settle the new aspect. Even you as a single person, if you try to divert, if you try to take up more things on plate, so ultimately what happens is that at times you might actually go overboard, and when you go overboard, ultimately you are going to lose focus from the existing business. So the expansion plans could ultimately lead to the existing business's performance to be deteriorated. Why? Because your focus is going to be shifted from the existing businesses to the new businesses that you are going to be acquiring, the new businesses which you are going to be expanding. Now, what next is there? It says the company's board has approved a plan to expand. Okay, we have read through this. Redback Sports Company has a small internal audit department with 2 staff who report to the finance director, as the board does not have an audit committee. Now, what I could say here is that, you see, what are we trying to do? We are trying to identify the business risk. We have covered this, we have covered this. We now need to cover this, which is that weak corporate governance. Now, why is there a weak corporate governance? What is it that is letting me believe that there is weak corporate governance? I am not writing down the future answers in the form of proper worded paragraphs, but I'm now going to write down the bullet points, because I personally think that now you have an idea how the answers are going to be written. So it's good that you should get to know the bullet points that we are going to cover up. So see, one of them is my pointers that I'm going to say, that some of the existing practices adopted are good practices. Entity has no audit committee. This would mean that the internal audit department reports to finance director. Further, the internal audit department is small, considering that entity is also planning for flotation. Ultimately, all above could lead to inefficiencies at the business, and hence, if ultimately what is going to happen is that if you don't have the audit committee, if you have got the poor internal audit department, so ultimately this is all going to lead to the inefficiencies, and the inefficiencies in the business operations, and may prevent entity from achieving its listing and expansion plans in the future. So you see, the good governance, because you are going for the expansion, you're going for listing, you plan to actually go for listing, you plan to go for the expansion. So ultimately what would happen is that you would want, I repeat, what you would want is that you would want it to be handled in a manner that you are ready for it. But in case if you don't fix this corporate governance issue, ultimately you would not be able to fix it properly. So for you to be able to fix it properly, you need to make sure that you comply with it. I repeat, you need to make sure that you comply with these corporate governance, because ultimately it is going to have a good impact on the business. Now, what next is there? Let's talk about the next aspect. I hope you people are with me, right? No one is sleeping, right? Okay, 1 mark per valid point. That is what the scenario is going to be. 1 mark per valid point. Okay, good enough. So now see, the next point is that it says the company offers a membership scheme whereby for an annual subscription, members can use the facilities at any of the centers. Customers who are not members can pay to access a center for a day under the company's pay as you go plan. Membership scheme accounts for approximately 85% of company's revenue, with the remaining revenue resulting from pay-as-you-go sales. Now, so what could actually happen is that assume that pay-as-you-go. What could possibly happen with this pay-as-you-go plan is that the existing members may not be happy with this. The reason being that there might actually be the situation that at peak times, um, there may be too much of the crowd, the facility may become very overcrowded, because usually on the Sundays or in the holidays, the members would want to come with their families. And if the members would want to come with their families, they're paying the annual membership, they're paying you the annual money. And if the people who just pay in and who just come in and occupy the space, if they come in, they would ultimately make the place overcrowded, and the members would not be happy. They would say that in case if everyone can come and pay and enjoy the facility, why should we renew the membership? So ultimately 85% of your business is on the members membership subscription. This could get affected because of this. So there is another business risk, which is that the pay as you go plan negative impacts on revenue. So pay as you go will drive more traffic on holidays. The centers will become overcrowded. Existing members may not like the places to be overcrowded. They may not renew their memberships. Could have an adverse impact on the businesses, profits and sales. So you see, this pay as you go plan apparently seems to be a very good plan, but it could have a negative impact on the entity. Why could it have a negative impact on the entity? Because your place is going to become overcrowded, because many people are going to be coming in who would have actually not paid the membership fee, Now let's move a bit forward and discuss further. The next aspect is that the business developments in the year. It says the industry is competitive. You see, what am I doing? I'm actually applying these Porter 5 forces. I'm actually applying the building block model. This is what I'm doing. It says the industry is competitive and the company's strategy is to encourage customers to renew their memberships and attract new customers by offering a range of new activities. According to finance director, a successful initiative which started in March 8 is the Healthy Kids campaign. This offers children 2 hours coaching per week in a range of sports, including swimming and tennis. Coaching is provided free as part of the parents' membership and has proved to be very successful. This is good to drive more traffic. Finance director estimated it has led to 3,000 new members since it was launched. Now, there is an important thing, which is that the industry is competitive and the company's strategy is to encourage the customers to renew the membership. So when the industry is competitive, so this means that in order to retain market share, discounts to be offered, marketing expenditure to be incurred, and regularly changing policies and procedures to be adopted, and resultingly what happens is could have an adverse impact on profitability of the business. Why? Because the competition has increased. So ultimately, if the competition increases, this would have an adverse impact on the entity's capability to operate with good profits. Why? Because the competition has increased. Now, what next is there? In 2008, the company opened a new coastal sport and leisure center, which was which as well as offering the usual facility, also has a scuba diving center and offers the water sport facilities. An investment of $12 million was also made in the new gym equipment across all centers to ensure company offers the most modern facility to its customers. So there is another thing which you are going to say, which is that the industry is capital intensive. The industry is capital intensive. This is also another risk that you face whenever you are operating in capital intensive industry. The investments are needed to maintain gyms and competitive positions. So inability to invest could compromise businesses growth and performance. I repeat, the inability to invest could compromise the business's growth and the performance. That is something that could happen. If you are unable to invest, it could ultimately compromise the business's growth. It could ultimately compromise the business's performance. Okay, now the next thing is it says an advertising campaign has been launched to promote the company's brand generally and to make customer aware of the investment in the facility which have been made. As part of the campaign, company paid 1 million to a famous athlete to endorse the company for a period of 2 years. Athlete will appear at the opening of the new coastal sports centers and has agreed to feature in the poster advertisements. So what is ultimately happens is that you have to invest heavily in the capital intensive and okay, this competitive and marketing expenditure that I already discussed here. Now it says Redback is also involved with the government initiative to help unemployed people have access to sport facilities. Now, the company received a grant of $2 million, under the terms of which it allows unemployed people 3 hours to have free access to its facility per month. By the end of November, 33,900 free hours of facility have been provided under this scheme. Government intends to run the initiative for 3 years to promote long-term health of the participant. Now see, again, if you are participating in this free health facility, so there could actually be the capacity issues and existing business renewal. Now see, entity is part of government initiative. To earn the grant, it has to provide free facilities to the unemployed. There could be social issues can arise due to different income levels. The existing members may not like presence of government sponsored people. The member base could be reduced. Further, the facilities can become overcrowded. Excessive capital expenditure may be required. Excessive capital expenditure may be required to meet the demand. So all this could have an adverse impact on entity and its operations. Because you see, what happens is you are operating in a situation where you have no choice except to actually, if you wish to earn the government grant, you have to provide these free facilities, and hence this could have a social impact also, because when people of different income levels, they come into spend the time along with you people, so that ultimately have an impact on a lot of people. A lot of you might actually be wondering that can we talk about such things? Yes, this is a fact. This is not something that we could say that it's unethical. No, it's a fact. Okay, now a new data management system has been introduced which integrates membership information with accounting software. This allows more efficient management of the customer database, which is used extensively for marketing purposes, as well as providing more timely information on financial performance to management. Data from the previous system was transferred to the new system in July 8, and the two systems ran in parallel for 2 months while training was given to staff and the new system was monitored. One feature of the new system is that it records and reports on the free hours of access provided to unemployed people, which the company has to report on a monthly basis to government. Now see, what happens is there could only be one issue with respect to the new system, which could have an adverse impact on the business, which is that may not be efficient, may have bugs, could distort information reported, could distort the information reported, and hence affect timely and correct decision making. So that is something that could happen because of this new system, and that is one of the business risk of this new system, that these are the issues that can arise. Yeah. So what have we done? We have actually gone through part A of the question. That was about business risk. A lot of you people would be wondering that, do we actually have to write down this much? Okay, it's me doing it, right? It's me doing it. For you people, I know that you won't be able to write this much. I know you won't be able to write this much. It's just that if I'm going to tell you people, um, I know if I'm going to tell you people this many things, this many points, then you will be able to have you'll be able to write some of these points. So basically what happens is that usually the examiner has got 1.5 mark for each risk, at times 2 marks, at times 1 mark. So even if you write down 4 risks, 5 risks, that is going to be sufficient enough, because from the exam perspective, you know this thing, you cannot identify these 8 risks which I have identified here. You see, you know this thing from the exam perspective, you cannot identify this many risks which I have identified over here. Now, so we are done with this part A of the question. In case if anyone has got any issues, any questions, any problems, let me know and I'll be happy to answer. If you all are okay with it, just let me know and I can move forward now. Yeah, please. I'm waiting for you people. Okay. Okay. Now there is a question. The business risk identified are okay, but how does it have an impact on the financial statement to be of concern to the auditors? Okay, now see, what happens is that ultimately, if there is a business risk, that might lead to a risk of material misstatement. How? I am going to guide you in a bit. But for the time being, you don't have to worry about how it would have an impact on financials. No, you just have to think that how could it have an impact on the business? What could be the negative impact of this on the business? That is something that you have to worry about for the time being. Okay. 4 to 5 points are sufficient enough, Samuel. Okay, now let's move and let's discuss further. The next aspect is that you have to evaluate the risk of material misstatement to be considered in the audit strategy and the audit plan. So you've got the exhibit number 3 in front of you. I repeat, you people have got exhibit number 3 in front of you. What I would want you people to do is that you go through exhibit number 3, keep in mind what was discussed in exhibit number 2, and try to identify the risk of material misstatement. You have got again 5 minutes time. to attempt this part. So I'm again giving you 5 minutes time to attempt this part. So that is, you've got time till 12:43 a.m. This is the time that you have got. Remember, you've got the financial data available here. So when you've got the financial data, you have to perform the analytical procedures also. So you've got 5 minutes, go through it, go through exhibit 3, try to see what could be the risk of material misstatements here. Okay, so now what have we got? We have got this specific part exhibit where there are multiple types of financial information available. Now see, whenever the examiner asks you for the risk of material misstatement, thank you Huda for your feedback. Okay, I'm gonna refer to them and then you can compare that. What are the points that you have covered and what are the points that you have not covered? So now see, whenever remember that whenever you are talking about the risk of material misstatement or the business risk, so what you could do is that you could think of that what could go wrong with financial statements. So what can you think of? You can think of what could go wrong with the financial statement. That is something that you have to think of. Now, how exactly am I going to think of this, that what could go wrong with financials? Let's try to have a discussion on this. Here you could see the revenue based on the projected figures at 28 Feb 9, based on audited figures at 5th Feb 2008. This is 45 million, this is 53 million. Now it says revenue is forecast to increase significantly this year. This is largely due to the success of the advertising campaign featuring the celebrity athlete, and the Healthy Kids program. Now, there are few things that you have to keep in mind. First of all, um, because you see, what happens is we need to see what could be the issues with the financial statements. Now, the first one of them is if I talk about the revenue recognition, because what I'm trying to do is that I'm trying to read through Exhibit 3, trying to identify that what are the risk of material misstatement, and then I'll go back to Exhibit 2 and try to see more. So with respect to revenue recognition, one of them is that uh, see the membership fee, the membership fee is for a year and not and should be recognized over the whole year. Risk of revenue being recognized upon receipt of subscription rather than over a period of time. Further risk that accounting for new streams may become complicated, like pay as you go, and free visitors sponsored by government. So there is an overall risk that revenue may be overstated. Do you people get it? Do you people get it? What did I do? I just went through the revenue area. I connected the scenario. I connected the situation and I said that I am facing a risk. As an auditor, I'm thinking that there could be issues because if you are receiving membership fee, there could be a risk that you might not recognize this membership fee over a period of the whole year. Rather, you recognize it immediately. Further, you have got new types of revenue recognitions that would be coming in. So ultimately, there is a risk of the revenue being overstated. Now, income from government grant, last year it was 0, this year it's 2. The grant received a 2 million. the details of which are explained in Exhibit 2, has been recognized in full as income for the year. If I could just go back to the grant and if I could just see that what was the terms of the condition, it was basically, where did it go? Where did it go? Okay, yeah, here. The company received a grant of this month under that policy, which allows unemployed people free access to facility. Government intends to run the initiative for 3 years to promote long-term so and so, so and so. Now, see what happens is that with respect to the government grant, you see the condition attached is 3 year. The amount received is to be recognized over 3 years. The entity has recognized it in full in current year. There's a risk that accounting is not rectified, resulting in overstatement of profits and other income. You see, you have got a condition which is that the government intends to run this for 3 years. So if the government intends to run this grant, this scheme for 3 years, this incentive for 3 years, you cannot recognize the revenue, you cannot recognize the grant in full right now. You got to recognize it over a period of 3 years. Next, the next point is it says the operating profit margin, which was this 10.7% and is 15% right now. The company's operating expenses include the following. The staff costs are expected to increase. The marketing, it says, is the same. The maintenance and repair of facilities is the same. Okay, now see. What happens is that the operating expenses, staff cost is projected to increase. Marketing expected to remain same, which is not valid considering new campaigns are being run. The repair and maintenance should increase considering expansions and capital expenditure planned. There's a risk that operating expenses are understated. So what is it? There is a risk that these operating expenses are understated. This is what the risk that you are facing, that the operating expenses are understated. Now, the next one of them is, it says capital expenditure was mostly financed through borrowings. Where is it? We've got the profit before tax, which is budgeted to increase. You can even calculate this, this PBT margin, or the margin, which is going to be 4.6 million divided by 45 million. So 4.6 divided by 45, ultimately 10.22%. We could calculate it here also, 6.9 divided by 53. 6.9 divided by 53, which is 13%. So ultimately the profit before tax is budgeted to increase, which is unlikely the case, considering that you are planning to expand, considering the expenses are going to increase. So there's probably going to be some expense understatement, etc., etc. Now, capital expenditure and associated borrowings. It says capital expenditure was mostly financed through borrowings. On 1st March, 10-year, 30 million loan was received from a company's bank. Loan does not bear interest. Okay, so that's a zero coupon loan and is repayable at par value of $34 million. You have obtained 30 million, it will be repaid at 34 million. As well as the bank loan of 1 million was advanced to the company from its managing director, Bob Glider. The managing director is a related party. The term of this loan includes 3% interest rate paid to Bob annually in arrears, and the capital will be repaid in 7 years' time. Now see, what happens is that one of them is the loan. So what could be the risk of material misstatement here? The risk of material misstatement that could arise over here is that the loan is zero coupon. Or you could say it's a deep discount loan or deep discount bond. The effective interest rate is required to be calculated. The interest expense shall be recognized using effective interest. The bonds carrying amount should be established using amortized cost approach. The risk that incorrect effective rate, incorrect accounting for amortized cost, resultingly understated interest expense and loan balance. That's one thing. The related party, the director, is a key management personnel. He is a related party. The transaction with related party requires multiple disclosures. There is a risk that related party disclosures are not provided. So there's a risk that the related party disclosures are not provided. That's one of the risks that's going to arise. Yeah, is this okay to all? Now, it says that the cash is 1.4 million, 5.6 million was the cash earlier. That means probably the business is having liquidity issues anyways. Number of sports and leisure centers, 18 and 20. 2 new sports and leisure centers were opened this year, as well as the coastal sports and leisure centers. A new center was opened in an affluent urban area in the capital city. So there are two new centers that are being offered. There are two new centers that are being opened now. So what is going to happen is that there could be a accounting for capital expenditure. I'm going to talk about that. Number of members is increasing. The management information shows that members visit a sport and leisure center on average 3 times per week. Okay. The pay as you go customers are also increasing. Now see, what is going to happen over here is that what I'll do is I will actually be looking at the different business risks that we identified, and we will try to see that can those business risks have an impact on the risk of material misstatement. So health and safety regulations, okay, not much. Expansion plans, the expansion plans, okay, if you will have the acquisition, we'll look at it. The weak corporate governance, yes. What could happen is that you could say that the control risks, weak COCG, a small internal audit department, there could be the risk that control weaknesses, the control weaknesses could have adverse impact on financial reporting information. That's one of the things. So when you would have the weak code of corporate governance requirements, weak internal control, ultimately this could have an impact on the financial statement. Then it says the entity plans to go for listing. Okay. If the entity is planning to go for listing, the management bias, pressure on management, planned listing, pressure on profits, the risk that policies aggressive policies to enhance profits and increase asset values are applied. So that is also another thing that is going to arise. And how have I established this? Through the scenario. There was further few things with respect to the scenario, and that was the capital expenditure. The capital expenditure. So what you could do is that significant capital expenditure is being planned. Old machineries may also be replaced/improved. There could be the risk of misclassification of revenue nature expenses into capital expenditure. So there could actually be this risk that the revenue related expenditure are classified as capital nature expenditure, and hence the carrying amount of the assets is overstated. Now, there is another thing, which is that the advertising campaign. So what happens is that the athlete is hired for 2 years. The cost paid should be recognized as expense over 2 years. There's a risk that it's recognized as expense at once, resulting in misstated marketing expense. Do you get it now? What do we need to focus upon? We need to focus upon how it would have an adverse impact on the financial statements of the entity. What do we need to do? We need to see how it would have an adverse impact on the financial statements of the entity. Do you people get it? Okay, so what have we done? We have actually gone through the part A and part B of the question. The part C of the question actually required us part C, D, and E. C required us audit procedure, which is going to be the agenda for our next session. There is this D and E again, they are going to be the agenda of the future sessions, where we will be discussing about the review engagements and etc., and the ethical things and all. So what I'm going to do is that I think we are done with this specific question, the name of which was Redback Sports. I know I've not covered up everything, but my main agenda was the risk of material misstatement, audit risk, and the business risk. That's what my main agenda of the today's session was.